On today's video, I want to take a look at the mini bubble in the stock market, and I'm going to say that this has been created by central banks, and this is not going to end well. Uh, I predicted that the market would be propped up into the FOMC meeting. Also, there was a State of the Union address here, and the Fed has the Humphrey Hawkins address this week. So they're going to continue to pump QE, and they're going to continue to intervene in the markets to prevent them from correcting. But this is not going to end well. They, clearly they're trying to stop the market from pricing in the damage done by the coronavirus. So far, we've got, in just a little over a week, we've gone from 9,000 cases to well over 40,000 cases, and this is just confirmed. Who knows what the unconfirmed count is? Probably double. But it's clearly it has stopped China. China has ground to a halt, and if the second largest economy in the world has come to a halt, then it's going to cause global economic problems. But the markets are prevented from pricing this in. I guess central banks think that they can duct tape over the problem and prevent it from happening, but money printing and interventions in stock markets are not going to stop the spread of the virus, and they have not been able to stop the slowdown or shutdown in China. And so at some point, reality is going to come back to the market, and then you create a structure like this. What always happens is you get some kind of a crash. Prices just stretched way too far above the long-term moving averages. So here's the weekly chart with the weekly 200-week moving average. You can see it's even, the picture is even more horrifying here. So unless this is going to turn into a final bubble, which just seems unlikely to me, we're still early in the innovation phase. We don't have 1,000 companies piling into the artificial intelligence phase, none of them profitable or have any prospect of being profitable. And, the kind of excess that symbolizes a bubble, it isn't happening yet. And I think it's just because the innovation phase is still fairly young. It's only about a little over 10 years, and it usually takes 20 to 25 years for that innovation cycle to mature and the excess to develop, and then you get the secular bear market that follows. So this just seems too early to me for a final bubble phase. This seems like a central bank created mini bubble in an attempt to convince the market that we're not going to have a global slowdown. But like I said, all the money printing and all the stock market intervention in the world is not stopping the virus from shutting down China, and that is going to affect the rest of the world. So I think what's happening is we're close enough now to 10,000 that the market is, or that number is acting like a magnet, trying to pull the market higher. In a natural market, in a natural market, this daily cycle right here would have been our corrective cycle. We would have, the market would have rallied maybe up to 9,000, and then we would have had a pullback at least back down to this 200-day moving average. But that wasn't allowed to happen. We had significant market interventions to stop the intermediate correction. So they've prolonged this, and we're now into a fifth daily cycle, and at this point probably close enough to 10,000 that traders are willing to ignore the risk that is occurring in China and in the global economy, and now they're focusing on that 10,000 number as if there is no risk in the market. Saw the same thing happen with oil back in 2008. Oil was um, you know, the um, prevailing mindset at the time was that oil was going to $200 and that there was a severe shortage of oil, which was ridiculous because we had tankers setting in the Gulf of Mexico with no place to dump their oil. But the market was willfully ignoring reality in its quest for a number. And I think the same thing is probably happening here with the NASDAQ. The market is willingly ignoring the problems that are unfolding in the global economy in its quest for achieving a number. But at some point, the market is not going to be able to ignore that um, any longer, and this market is set up for a gigantic crash, um, possibly all the way back down to this 200-week moving average, or well, this is the 200-day moving average, would bring the NASDAQ back down to 8,200. Now, if we were in a natural market, you would have a considerable amount of smart money traders that were long this entire rally um, in the um, attempt to achieve that target of 10,000. But a lot of those traders, at some point, once you get close, maybe you've only got 1 or 2% more to go to hit 10,000. So those traders, they just sell their position. They figure they've made enough money. There's no sense pushing it and chancing getting caught if the market doesn't achieve the target. And so that's what should happen naturally. And we're in that zone right now. The NASDAQ is only about 4% from 10,000. And so all these traders that have been hanging on to long positions are probably going to just figure that they've made enough and it's not worth the risk of hanging on in the event that stocks do not hit 10,000. In a natural market, we would probably get some kind of a significant corrective move before we get to 10,000. In this central bank protected market, I don't know if that will happen or not. But I can say with a great deal of conviction that since I think it is too early in this bull market to have the bubble phase, that the central banks of the world have created a massive problem allowing the market to do this, to stretch this far above the moving average. And they have created the conditions for a huge crash. I don't know whether that's going to start at NASDAQ 9,800 or we make it all the way to 10,000, or maybe we even go a little above 10,000. But I think I can guarantee that you don't need to chase this, because at some point in the near future, this market is going to collapse and you're going to be able to buy the NASDAQ at least at 9,000 and maybe as far back as 8,500 or even lower sometime this spring. So you don't need to be foolish and just chase this thing higher, and unless you just feel like you've got plunge protection team protection from here to 10,000. Maybe you could play that move, but for the rest of us that can think logically, this is not something you want to fool around with, and ultimately it's going to create a massive crash, and then central banks are going to have to print even more money, and I think that's why bonds and gold gold are not moving down significantly. Smart money is already sniffing out that a major problem is brewing, and bonds and gold are both trending sideways, and gold, despite the fact that the dollar is rallying strongly. So here's the gold chart. You would think with the stock market going ballistic that gold would be dropping significantly, but it's not. It's going sideways, and I think gold is already sniffing out that there is a huge, huge problem about to unfold in the global economy and in the stock markets, and that's why gold is not dropping significantly like you would anticipate with stocks going parabolic as they are now.